Hello. Welcome to our next IND AS, that is IND AS 7 Statement of Cash Flows. So IND AS 7 defines or in fact bifurcates, classifies cash flows into three types. That is, first is operating activities, second is investing activities, and third is your financing activities. So operating activity, that is your main business, So whatever cash you generate from your main business is your operating activities. Whatever cash, wherever cash you invest, that might be in your bank, that might be in your assets, that is your investing activities. And last is your financing activity, that is redemption or raising of funds. So operating activities is derived from the principal revenue producing activities of the entity. Your investing activities are activities that result in acquisition and disposal of long-term assets. And your financing activities related to raising and redemption of funds. It also includes your cost of capital. Okay. So to give you a better understanding, I have also given you some examples. I want you to go through these examples on your own. And for those who have purchased the notes, I have also left space. I've also left space for you to add your own point that you might find out while solving questions. Okay. So your sale of goods and services, receipt from royalty commission, payment for premium, any claims, etc., payment to suppliers for goods and services, payment of salaries to employees, payment or refund of income tax, receipt from assets held for sale. These all will be operating activities. Now, what is investing activities? Profit loss on sale of assets, sale purchase of long-term assets, sale of equity or debt instrument, advances and loans given out, receipt from futures, forwards, etc., shares purchased of another company, any interest or dividend that you have received, all of this will be investing activities. And your financing activities would be your cash proceeds from issuing shares, your own shares, cash proceeds from issuing debentures, loans. So this was equity, first point. Second is debt. Third is payment to redeem own shares, that is you are buying back your own shares. Next is payments of amounts borrowed. That means when you are repaying the debt. So first is raising equity, second is raising debt. Third is redeeming equity, fourth is redeeming debt. Next is payment by lessee in case of finance lease. And last is any interest or dividend paid. So you have to see interest or dividend paid comes under financing activity, but interest and dividend received comes under investing activities. Make sure to remember this during the exam. Now there are two methods. There are two methods for making a cash flow. One is your direct method. So how does direct method work? Direct method works. You've got cash, recorded. You paid cash, recorded. But your indirect method starts from your net profit. It starts from your net income, and then you subtract, add based on certain logic, and then you come. Both these solutions will give you the same answer. It is just a different method. So direct method format is usually is very easy, and most probably they will not ask this to you in the exam, but still you should be knowing. So basically direct method format, what does they do? They bifurcate these activities into three. That is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Okay, so these are certain examples also I've given. And whenever there is any negative sign, that means cash has gone out. So any cash received minus cash paid is your cash from operating activities. Similarly, you will have cash from investing activities, you will have cash from financing activities, and then you will get a net increase or decrease. That is all of these sum, you will get a net increase or decrease. This is net increase or decrease during the year. This is what is the cash balance has changed during the year. So if you add this to the opening cash balance, of course, you will get the closing cash balance. So what happens? They will usually give you the opening cash balance and the closing cash balance. So therefore, you will get to know during the exam only if you've done this right or not. Okay, now next is your indirect method format. Indirect is a little complicated. I will not go into logic as to why what is being added, why what is being subtracted. I will help you to learn the format. So you start with your net income, that is net income you start. Then you add non-cash, non-operating expenses. That means any expenses that is not in the nature of cash. What is such an example? Depreciation, correct? So any non-cash or non-operating expense Why? Because we are calculating only operating activities. So if there is any loss on sale of asset, now tell me, loss on sale of asset is a part of operating activities? No. So therefore you will have to add this back because it is not an operating expense. So over here, what do you have to add? You have to add which is neither cash, not a cash expense, or which is not an operating expense. Okay, because over here we only want to find out operating activities. So therefore you add NCNOE and you less NCNOI. It is exact opposite logic. Okay, so this part I hope is clear. Next is you add decrease in working capital. Working capital is your current assets minus current liabilities. So if your current assets minus current liabilities has decreased, then you add this amount. Okay. So this will be added. That is increase in current liabilities or decrease in current assets is what is the effect will be given. If there is any increase in working capital, that will be subtracted. That means if the current liabilities have decreased or if the current assets have increased, you will be subtracting it. Okay, that is what you get, changes in working capital. So I hope both of these are clear. So you add decrease in working capital and you less increase in working capital. That means if you see, both of these are opposite. Working capital, if for learning purpose, if you want to see, if working capital is reducing, you add it. If working capital is increasing, you subtract it. Next is any taxes paid has to be subtracted, and now you get is net cash provided by operating activities. If you remember in the box that we studied, taxes paid also comes under operating activity. So therefore, you subtract the tax and you get net cash provided by operating activities. Okay, what next? Investing activities. Now, only the first part is complicated. Your investing activities, financing activities remains the same. That is dividend received, loans given. These are just examples that you get net cash used in investing activities. This will be negative. Okay. Financing activities. Financing activities is dividends paid, repayment of bonds. That is net cash used in financing activities. So if you see, this is same in the direct method also and indirect method also. Your investing activities and your financing activities is same in both the methods, only your operating activities is different. You get a net increase decrease in cash, you add it to opening, and what you get is your closing cash balance, plain and simple. Okay, so this is a very easy index, you don't have to get scared of it, very logical. Okay, now some miscellaneous points to remember. Any foreign currency transaction will be converted using the exchange rate at the date of the cash flow. It will be converted at the exchange rate at the date of cash flow. When the cash flow happened, on that date, whatever the rate was, it will be converted using that rate. Next, aggregate cash flow arising from obtaining or losing control of a business is an investing activity. That means when you buy a business or when you sell some part of the business which is now not under your control anymore, it will be called as investing activity. It will come under investing activity. Cash flow that do not result in loss of control of business or subsidiary is financing activity. So if, say for example, you owned a subsidiary, you had 100% subsidiary and you sold 60% of the shares. So now you do not have control over it. So whatever money you receive, this will be called as investing activity, because you this cash flow arose from losing control. Okay, so this will come under investing activity. But say for example, if you have a 100% subsidiary and you sold only 10% of the shares, so whatever money you receive, did you lose control? No, you did not lose control. It did not result in loss of control. Hence, this will come under financing activity. So only these certain small changes here and there. So therefore, I put them in a separate note so that you don't get confused in the exam. If say for example, they ask you this in MCQ. Next, transactions which do not involve cash will not be part of these statements. Easy. If you purchased any machine in exchange of shares, is there any exchange of cash? No. You got a machine, you gave shares. Is there any cash? You are studying cash flow statements. If there is no movement of cash, it will not come anywhere in the format. Easy. I've also left some space to add your own points. All the best, and we are done with this chapter.